Okay, what we're going to talk about today is your credit and you. So I would like to introduce, first, say a thank you to all of our sponsors. California Coast, who is in the back of the room. You can feel free to visit their tables afterward. San Diego Financial Literacy Center, the Mason College Foundation, Associated Students, and California Burrito. So let me introduce our speaker. Our speaker is Chase Peckham. He is the Director of Community Outreach for San Diego Financial Literacy Center. He serves as the organization's liaison to high schools, colleges, associations, local businesses, and especially our armed force community. He focuses on financial wellness, education, and awareness, and oversees all of the educational content, working with partners and officials to further the mission. Chase actually started his career with the San Diego Padres. So he was with them over 10 years. He had many different hats, including video production assistant, including as the senior editor and producer. Along the way, in 1999, Chase won an Emmy for his Padres 1998 season biography, A Season of Heroes. Chase serves on the foundation board of the Stone Ranch Elementary School. He also received his BA in Communications from the University of San Francisco. So without further ado, Chase Peckham.
Every time he brings up the Emmy, it makes me laugh. I forget about that.
Sorry. It's okay.
It's
You can blame us.
no, that's quite all right. No problem. So I just got done in Howard's class talking about this very subject, but a little not as in depth as we're going to get here. If you have any questions at any time, or you have experiences that you think that you want to share that are along the lines of what we're talking about, I think it's a good idea, because the honest truth is, when it comes to this information, we learn a lot more from each other in real life scenarios than just having me sit up here and talk. But you will find that there's going to be some confusing information here. So if you don't completely understand, or you think you want me to elaborate a little bit more, let me know, and I'll do the best I can. We're going to talk a little bit about what credit bureaus are, who are they, what do they do? Credit scoring overview. What do they do? Are they correlated with your credit report? Are they the same thing? How credit scores are used? How do we improve them? How do we improve our credit? When we talk about credit, we're talking consumer credit, like in the name of the presentation. And then also what we can do to protect ourselves a little bit. This slide right here, all of you should have a handout that'll have these slides. So some of them I'm going to go over very quickly. Some of them I will kind of elaborate a little bit more. Again, if you have questions on them, please don't hesitate to ask. What this is showing is that credit, even though credit bureaus or our credit scores tend to be the most well-known way of people finding out and looking at our financial background, there are many more. When it comes to overdrawing your checking account, which is what Check Systems is. When you're talking about insurance, talking about public record, if you've been sued and those kinds of things. There are many different databases that keep track of different financial aspects of us. A lot of us don't know that. Okay? So we're going to get right to it, though. As I mentioned, the three most famous and actually the most commonly used for credit reports are three credit bureaus: EXPERIAN, Equifax, and TransUnion. All right? You guys have probably heard of EXPERIAN in the last year and a half or so. Does anybody know why? You've heard that name. Say it again? Oh yeah, they had a big breach. Yeah, millions and millions and millions and millions of people had their reports, their information breached when they got into the EXPERIAN reports, including myself. So that's why I have a big credit monitoring service that is watching my every move. The big misconception about these bureaus, all right, is that they are government entities. They are not. The government really has nothing to do with these. These are for-profit businesses, all right, publicly traded. They are, in the last number of years, there are guidelines that they have to face that the government has put down for them, mostly to help us, the consumer. Not a lot, still free enterprise, but these are organizations that are for-profit businesses that are marketing companies. Let me say that again. Credit bureaus are marketing companies. They sell our information. They sell our information to businesses that want to do business with us in the future. They also sell information to businesses that we want to do business with. So if we want to go to Cal Coast Credit Union and we want to open up a new credit card account or a car, we want to see what kind of car loan we can get, or a home loan with them, they are going to pull our credit scores that have reflected from these credit bureaus, the information that they keep. Does that make sense to everybody? They will pay to find out information about us to assess whether they want to give us a loan or not. Does everybody understand how that kind of works? Why they do that? Because they collect this information on us whether we like it or not. And by the way, rest of the other countries all over the world do the same thing. It's just a little bit different. We don't actually talk to each other. The United States has theirs. They don't talk to Australia or England or other things like that. So when they're looking at credit, it's based on credit that you have here in the United States. Does that make sense? So that could mean that if you're coming from, let's just say you moved to the United States from Australia, and you had great credit established in Australia, you could come to the US and you're looking to buy a home here and you're looking to get a loan. Cal Coast can look that information up. You will not have any information, any credit history, because you don't have credit history here. Does that make sense to everybody? Okay, so that really just depends on where you're from and if you have history in those countries or based on where you are, where you're applying. Okay? Any questions on the bureaus? All right. So the bureaus have what are called credit reports. A credit report is a record that lists all past and present debts and or accounts that you currently have and have had in the past. Now, when I say in the past, it can be as far back as 7 years ago if the accounts have been closed. I will get into that a little bit more. I don't want to confuse you yet, okay? Because I promise you there will be a point where you're going, I don't get it, and we'll get there. The credit score, which is most famous. How many people here have heard of credit scores before? How many people thought credit scores and credit reports were the same thing? They kind of are, but they're not. They're separate entities. A credit score is a completely separate entity, separate companies that basically what they're doing is they're assessing, they are navigating, looking at our credit report. It's a statistical method basically saying, whatever's on your credit report, we're going to come up with a mathematical equation that will tell somebody very, very quickly. So in this case, I'm going to keep using Cal Coast Credit Union. When they're looking things up, they don't want to go through, as Howard mentioned in his class before, 120 some pages in his credit report to find out what's going on, right? What they want to do is they look up a score or two that looks up and says, he has a score of 790. All right, now we're talking. All they have to do is look at that number and they say, great. We like the way that you look. You have healthy credit. Let's talk about what kind of loan you're looking for and for how much. Right? Okay, that's what that is. But they are two separate things, but they do work together. What is on your credit? All right, how does it get there? Okay, we're going to get to that even more. But how does it get there? These establishments. So Cal Coast Credit Union, when you open up an account, let's say you have a car payment, that you have a car loan with them. You pay Cal Coast Credit Union every single month for that car that you're paying back, right? So every month, Cal Coast Credit Union sends information to your credit reports, giving them information on your account balance now. All right, so when that happens, your account, your credit report, your credit scores start to go up and start to build based on the information that this organization sends them. Every organization that you have an account with, credit cards, car loans, banks, credit unions, other types of lenders, that information gets sent to those credit bureaus. Now, to confuse things a little bit, not all three may get sent the same information by the same company. I don't know CalCoast Credit Union's practices, but it might be that they only send information to Equifax, which means that TransUnion and EXPERIAN may not have the same accounts on there. However, I will say that usually most of the major institutions do send all three because they want accurate records. So as much as they want the information accurate on their getting on you, it's beholden to them to send that information as well. But as I mentioned, there is no law, no rule that states that CalCoast Credit Union must send this account information to the credit bureaus. None. They do that because it's part of the system. They want correct information as well. So it's typically just an industry-wide thing known that they're going to send that information. Okay, but nobody is making them do it. And the same comes as the same side goes for us. We cannot dictate what goes on our credit reports and what doesn't. The only time we have a say on what goes on our credit report is if something is misinformation, that it's not correct. Then we have something to say about it. But the only way we're going to know whether correct information is on our credit reports is if we actually take a look at it. Because there is no police, there is no entity that is checking to see if information that's on our credit reports is correct. The only way we will know is if we look ourselves, unfortunately. Because we need to look. Why do you think that it's important that we would look to see what's on our credit reports? Anybody? Yes?
Because things can be on our credit report that we've never purchased.
100%. There could be accounts on there that aren't yours. As Howard had mentioned earlier, if you're a junior or a third, you're John Smith III, not only do you have a very common name in John and an even more common name in Smith, but you're a junior or a third, do you think that there might be some mistakes on the credit reports a few times? Do you think they might get people confused? It happens. It happens a lot. There's completely misidentification. It can also be that there's been identity theft. There might be that somebody has gotten your social security number somehow and they opened up accounts in your name and you don't know it. This can happen. I don't mean to scare people. I'm just saying it happens. 1 in 2 credit reports in the United States have misinformation on them, have a mistake. Now, how heavy that mistake? It might be just the misspelling of a name. It could be somebody else's account. Really just depends. All right? Now, the way that this is reported is it's monthly and not necessarily on the 1st of every month. As you guys know, how many people in here have credit card accounts or have a car loan or something like that they pay monthly? Okay, so do all your bills always come out on the 1st? Not really, right? So that's why these accounts are called billing cycles. So at the end of every billing cycle, when you have your due date, that's when, right after you make your payment or don't make your payment or whatever it might be, that's when those institutions are going to make their reports, send that information to the credit bureaus. Now, depending on how many accounts you have, that information might be sent at all different times, right? So you could actually look up your credit score one day, and it might be a certain number, and you could look it up a week from now, or even a couple days from now, and it might be a slightly different number. Now, is it going to be a major difference? Only if you did something major, like you went out and bought a new car, or you went out and bought, a lot of furniture or something where the accounts would change. But what your credit score is really is based on when you look at it or when it's pulled. Okay, so it can change. Now, again, I want to reiterate, does it change majorly? Probably not, but I will tell you, I get sent my credit report, my credit score from TransUnion by Bank of America every single month. I have yet to have my credit score come back the same every month. It changes by points, a certain amount of points every single time. I have had as good as 850 And then just recently in my last one, it was 826, which is still a great number, but somewhere along the line, there was some points deducted for whatever reason. Okay, and that's what we're going to talk about some more as we go. Are there any questions on that? What is on your credit report? Identifying information. And we're going to show you this here in a second. Where you live, addresses. Not only addresses where you live currently, but possibly where you have lived before. I have, in fact, the last time I looked at my credit report, it had addresses from the last 6 places I've lived, including places that I lived when I was in college, which was just a number of years ago. Just a couple, right? So that information will be on there. Your social security number, typically it will be X'd out. Okay? If somebody else is looking at your credit report for marketing purposes, they will not see your social security number. The only person that can see the social security number at all is you, if you pull your own account. Okay? Then you have what's called public record. If you have no judgments against you, meaning public record is anything that has gone through the courts or has gone through the law. Okay? So if that information is there, if you've been through a divorce and you owe child support, the information that you owe child support will be there. Okay? If you've ever had foreclosed, if your home has been taken because you didn't make payments, that information will be there. Tax liens, any of those kinds of things will be on your public record. If you don't have a public record, that will be blank, will not exist. So hopefully nobody has public record on there, right? Yes?
So based on the previous slide, having a perfect score means that you pay everything on time?
Having a perfect score?
Yeah.
I'll be honest with you. I have gotten the 850 once. I've seen it maybe 3 times in my entire life that I've done this. The score itself, a perfect score, doesn't come around usually. And I'm going to show you this, but scores are looked at in tiers, so ranges, right? So right now, if you were to buy a home, the best possible, you'll get the best interest rates if you have 750 and above. Okay, so that's what they're looking at right now. That area right there is about the highest. Yeah.
What is the perfect score for
850. And I'm going to show you this in a second. And be careful, because there are hundreds of different types of credit scores, right? And I'm going to show you this in the next slide. But what you're looking for, about 90%, 95% of all organizations that are pulling scores pull from what's called FICO, F-I-C-O. It's the Fair Isaacs Company. They came up with the credit score. They are the most commonly used. But there are other credit scores out there. If you wanted to look up your free credit score online, you can possibly find it. Chances are it's not coming from FICO though. So apples for apples, it won't be the same. Okay? Credit accounts. This is the bread and butter of your credit report. These are called trade lines. Different types of accounts, whether it be a car loan, okay, which is called installment credit. It'll be in the installment section. The 3 bureaus, by the way, they all look a little bit different, but they all speak pretty much the same language. Okay? They might be set up a little bit differently, but they have all this information. Credit card accounts, personal loans, mortgages, any type of account where you're borrowing money and you're paying back, that information is going to be there, even if they're closed. And I'm going to show you this in a second. All right? All of this information stays current for the last 7 years. So if you look at your information now, you can look far back as information that is at least 7 years old. So if you have a current account and you've had it 20 years, you're only going to have information from up to the last 7 because that other information doesn't really matter. If you've had an account that has been closed longer than 7 years ago, that account information should fall off and not exist on that report anymore. So so if you had a bad account one time and you screwed up when you were 18 years old and you missed some payments and stuff, after 7 years that information will be like it never existed. Okay? Does that make sense to everybody? All right. And then we have what are called inquiries. Every time we apply for a loan, online, at the bank, at the credit union, however it might be, via mail, every time we apply for a loan, that information is sent to the credit bureaus that you applied for the loan. So if you have ever applied for a loan, there's a pretty good chance you have a credit report if they sent that information. All right? Everybody following me here? Now, I want to reiterate that there are two different types of inquiries. There's what's called a hard inquiry and a soft inquiry. Hard inquiries are when we apply for a loan. We are asking an institution, and I'm just going to keep using it because they're here and they're a financial institution, but Cal Coast Credit Union, if we go there and we apply for a loan, that information that they applied will be there, whether we get it or not. Okay? Now, if you were to apply for lots of credit cards and accounts in a short period of time, that will have an effect on your credit score for the negative. Not a lot, but it will have a little bit of a negative. All right? Soft inquiries have absolutely no bearing on your credit at all. But what they are there for is for information for you and for other organizations to look at who is looking at your credit report and why. And not really why, but we know why. Because again, remember I used the word marketing? They're selling information about us. So how many people in here have ever gone to the mailbox and gotten their mail? For their mom and dad, let's just say, or for you. You ever notice how much junk mail comes? How many offers you get? That doesn't happen by accident. There are organizations that are scanning our credit reports. They know exactly what kind of accounts we have. They know how much debt we have. They know all that stuff. And what they're saying is, we want a piece of the pie. So if you have a Cal Coast Credit Union credit card and you have a Bank of America credit card, you might get offers from Capital One or Citi or Chase. And the reason is they know what accounts you have and they're saying, hey, you know what? We want a piece of that pie too. We want to sell them a product, even though we don't technically have to pay for it. So we're going to offer them this awesome 0% transfer your balance for 0% for 24 months. So we're hoping that if you have a balance on Cal Coast credit card, we'll transfer it to ours. And now you can pay it off through us. It's kind of like refinancing a credit card. Does that make sense? So you can actually look at your credit report, and for the last 3 years, you can see all the different companies that have looked at your credit report, which is kind of fun. I do want to tell everybody, if you want to go pull your credit report, even if you don't think you have one, we by law, as citizens, can pull our credit report for free by going to the website called annualcreditreport.com. And you can pull for free your credit report from TransUnion, Equifax, and EXPERIAN for free one time every 365 days. All right? Now, I will tell you that you can also go to your banks or your credit unions and they'll probably pull it for you as well. By law, if you get turned down for a loan, they have to show proof of why they turned you down for that loan. So via credit score or credit report, and you can dictate which one you want. So this is what an example of a credit report would look like. This is your identifying information. You can tell that there's different types of names, right? Maybe different spellings. Maybe somebody had a mistake, but if you're a Charles, they might have Chuck or Charlie or Cap or whatever name you might go by. They will see the addresses, and as you can see, there might be different types of addresses. What kind of apartment what kind of house is it? Is it an apartment? It'll also have, and this could be really long, it could have 5 or 6 addresses on it. Not only that, but it'll have different information like when you were born. If you have a co-applicant on the account, does anybody know what I mean by co-applicant? Yeah, if you're buying a home and you need both of your incomes to go into the, because homes are really cheap in San Diego, right? So usually people on one income could buy a home. Well, it doesn't happen very often. So for instance, my wife and I might need both our incomes to get that loan. So we both have to sign the account. So both of us are just as responsible as the other for paying that on that account. So that information will be there. Who is the co-applicant? And just like mine, she will have something that looks just like this. And with that, co-applicant would be my name instead of hers. Does that make sense? Okay. So this is an example of having a public record. You might have been sued through the Clayton County Magistrate by a cell phone company or a wireless distributor because you didn't pay your bill. Now they're coming after you through the courts to garnish your wages because they want their money back. Does everybody understand that? There could be companies calling you and wanting the debt. It's different if they actually go to the courts to sue you to legally get the money back by court mandate. Okay? That is called a statute of limitations. Every single state in the United States has a collection debt of statute of limitations, how long you can collect debt. In the state of California, it's 4 years from the time that you go delinquent. After 4 years, and they don't collect that or try to collect that through the courts, they no longer have legal right to get it from you. Does that mean they can't try? No, they can try. They can try all they want. If you owe the debt, they can still try to get it. Does that make sense? All right, perfect. This just shows that this is a tax lien, and this one they went bankruptcy. Okay? This is what's called a trade line. This is an account, and in this case, an installment account, which is a mortgage. It has your account number. It has what your current balance or most recent balance is, the date you opened it. It'll have what kind of an account it is, if it's real estate. It'll also have all the information about how much you pay, what the original debt was, what was the original amount for, how much do you pay monthly, what did you do recently? So in this case, this person pays, they're only obligated to pay $1,275 a month. But last month they paid $1,500. They decided to throw an extra $250 on there. This is a lot of information, isn't it? This is how detailed this gets. And it's a good thing because it can help us. But remember, these were not created for you and me to find out how we're doing as fiscally responsible people. Or not responsible, depending on how we are. This was built for companies to assess risk on us. When we're asking to borrow money, those companies need to assess risk, right? How many of you have ever loaned money to somebody before? And then how many times, and let me ask you, did you get paid back right away? No, and it took time. So if that person asked to borrow money from you again, would you think twice about loaning them the money? Why? You have a history with them now, right? You know. So that's why when we're going to Cal Coast Credit Union, they don't know us from anybody. If they have to figure out what kind of interest rate they're going to give us, if they're going to give us a loan, and for how much, they've got to take these things into consideration, don't they? They need to know that about us. If we're going to loan some money to somebody, don't you think that we'd want to know something about them? Because if I walked up to you, you're not just going to loan me money, are you? Never met me before. You wouldn't loan me money. So why would another place loan us money if they don't know who we are? This is how they know. A negative account would look like this. Look at this little part down here. It's hard for you to see for some of you, I'm sorry, but you can see it on your printout. Down below it has what's called a payment history. If everything is green, or it has a check mark, or it says okay, depending on whatever the credit bureau is, if it's green, that means it's healthy. That means you're making payments on time. That is good. If you go into an area where it says, if it's a different color and it says 30 or 60 or 120, that's bad. That means you have gone delinquent. That means you have not paid your bill for that billing cycle. That will start to be a big negative on your credit score. That will start to hurt. If we miss payments, if you break a contract and just decide, I don't like this cell phone company anymore, and you don't go through the proper procedures of cutting ties with them, which means probably paying a fee of some kind, that's going to hit your credit because you have a contract. Same thing with rental agreements. The agreement that you sign when you take out a loan. When you take out that loan, you are signing that you are going to pay it back under the terms of however you took out that loan. Make sense? And then this is what I was talking about with inquiries. You can actually see the different types of accounts. So basically, Bank of America looked at them. Toyota Financial, you opened up an account with them or tried to open up an account with them. So that information is there when you did it. You can go back 3 years and see all the different places you've applied for credit. As I mentioned before, there are lots of different types of credit scores. you can see not only are there lots of different types of organizations that have credit scores, there's tons of different credit scores within those organizations. And they all will have different types of levels of scoring. Now, FICO, as I mentioned before, is the most prominent credit score. If you ever want to pull your credit and you want to know exactly what your credit scores are, go to FICO, FICO.com. It'll charge you, but it's not very much. But again, as I mentioned, you can probably go to your financial institution, and a lot of times based on if you work with them, they'll possibly give you your credit score. Like I mentioned, part of the benefits that B of A does with me is they send me my credit scores every month, just to let me know how I'm doing. Again, I have that competition with my wife on who has the better scores every month. But you can see here that they changed. So for instance, their closest competitor is called Vantage. Vantage Score was actually created by Experian, Equifax, and TransUnion. They wanted to get into the credit score business. They are in the credit score business. Anybody ever looked up a website called Credit Karma? Looked up their credit? If you get your credit score from them, you are getting what's called a Vantage Score. That's on a 900 scale. So if you walked up to somebody and you were going to get a loan at Cal Coast Credit Union and you're sitting down with the loan officer and you say, hi, I know what my credit is. It's really good. I have a 875. They might look at you a little funny because what they're looking at is not what you had just talked about. They probably, now maybe they pull a Vantage Score, I'm not sure. But again, most pull what's called a FICO score. Kathy, do you guys pull FICO scores? Yes. Yeah, that's what I figured. Most institutions do. Right? So that scale is based on 850 being the best score you can get, down to 300. Not too long ago, I said I've never seen an 850 before, but I have seen them every once in a while. But I will let you know, like I looked at it last night. 826 is my credit score as of yesterday. It could be different today. Now, is it going to be a lot different? No, because I haven't done anything fiscally, financially that would affect it. But a bill might have come due. My wife might have made a payment that's in both of our names. So now my debt to credit ratio might have gone down. That could affect it a few points, for the better or for the worse, just depends. Probably for the better in that case. All right, so FICO is really what you want to look at, okay? There are different, yes, sorry.
So I went to look up FICO through Wells Fargo, and then when I was like looking frequently, the score went down. So like, how is that?
So you're asking, did you do that by looking at it?
Yes.
No. You can look at your credit score all you want. However, I will say this. If you went through a financial institution and they pulled your credit score for you, depending on the way they pulled it, like they were going to pull it for an account, that could be the difference between a hard inquiry and a soft inquiry. When you actually pull, and when it comes to FICO scores, that will never hurt your credit. It's only typically when you're pulling your own credit report, or not even when an establishment pulls your credit report. If you pull your own, you can look at your credit 365 days a year if you wanted to, and it will have no bearing on your credit at all.
So like if I go to the branch and then if I ask the people there to look it for me, it's gonna affect.
So now that could be different. In the banking industry, depending on how they pull your information, the credit bureaus might look at that as a hard pull because it's coming from a financial institution. But it depends on how they're pulling it. There is different ways that institutions can pull information for us. Okay? So if you're trying to open up a new account and they're getting information that way, that's going to be a hard inquiry. If they're looking it up just for you to know for yourself, there is a way to pull that as well that will have no bearing on your credit. Okay? If you're looking for yourself, never. But it really just depends on how, because for instance, if somebody comes to my organization and I can look up credit scores for them, and I can pull their credit reports, there are codes that we put in that is telling the credit bureaus when we're pulling that information what I'm pulling it for. And if I'm pulling it for a client to go over with them for educational purposes, it will have no bearing on their credit. None. Okay, but if I put in the wrong formula or I put in the wrong code and I put in the code that says they're looking for an account, that's a different deal. Does everybody understand how that works? Okay. As I mentioned, there's different types of FICO scores. Right now, the typical FICO score is called FICO 8. FICO goes through and they're constantly trying to evolve in how they assess risk. So by the spending habits, they look at everything. They look at the way lenders lend. They look at the way we borrow. They look at all different kinds of factors all the time. So there's actually a score out called FICO 9. But most institutions are still, because they're used to it, are pulling FICO 8, right? Which is what we talk about. That's most common. FICO 9, the difference is, as I'm going to show you, they released this in 2016. It's still not widely used. But what they did is they're saying, we look at medical bills or medical debt a little bit differently than we used to. We have come to find that when it comes to medical, it could be a big extenuating circumstance that somebody gets hurt and they get a lot of bills, and they might not have been able to pay all those bills that time, right? So that might be a black mark on our credit report. So what FICO is saying is, just because you might have medical debt that you couldn't pay at that one time does not necessarily mean that you're not a good lendee or a good borrower. So they take medical debt less harshly than they do in FICO 8. So this one, because it's going to be newer, it will start to be used more and more. But they're constantly evolving. Okay? Does that make sense? This, like I said, this is confusing stuff. But at the same time, just understand that not everything is created equal when sent to the credit reports, okay? So for instance, like rent. We pay that monthly, don't we? But that information does not get sent to our credit reports. Because technically it's not a debt, it's a service. Same thing with cell phone bills. Those do not build credit. Where if you have an account, again, going back to Cal Coast Credit Union, to an auto account or a mortgage or credit card account or something like that, you get brownie points for making payments on time. They send that information no matter what, whether you're late or whether you're on time. Okay? With all those other bills that we pay monthly, all those other obligations that we have, like a cell phone or a regular phone or utilities, rent, that information only gets sent to the credit bureaus when we don't make payments, when we have negative information to send, unfortunately. Now, FICO is trying to figure out ways to incorporate rent and different things like that. But the problem is, not enough institutions send the information. That's the problem. It's not that they don't want to assess that. It's just that information doesn't get sent. So how do you factor in something that there's when it's not there? Looking at kind of, remember when I talked about tiers, you guys asked what a perfect score is? 850, right? So tiers are kind of like this. Now I want to preface this by saying this is a loose scale because of this. This is based on housing, okay? Because different types of lending is going to look at different scores differently. So meaning, if you're buying a home, right? 750 is going to be what they consider, and above is what they're going to consider tier 1 credit. Because the housing industry, you're borrowing a lot more money, right? So when you're borrowing a lot more money over a long period of time, because typically those loans are 15 to 30 years, so they're going to be much more tight when looking at the credit score than, say, if you go to buy a car. So Kathy can probably speak to this. The way that their lenders look at what they're going to look at as great credit for an auto loan is different than what they're going to look at very top credit for when they're purchasing a house. There's a little bit difference when you're buying a $20,000 car versus a $500,000 home, right? And all the agreements and the different things that are in the agreement, in the contracts are different. So they're going to be a lot looser on what they consider great credit for auto than they are versus a home. So for an auto, you might find that anything above 700 for Cal Coast Credit Union might be tier 1 credit for an auto loan, but anything above 750 for a house loan. Okay? So not all lending is created equal. And every institution's going to have different levels. You go to get an auto loan from Cal Coast versus going to Toyota directly, They're going to have different boundaries on what they think is good risk or not. So that's why it's important when you guys go to buy something or you're looking to go get a lending, shop around. Go to a credit union before you're going to buy a car and find out what you can afford to buy and what kind of interest rate you can get from them. So when you walk in to buy a car on a lot, you're not just looking at, I just want to buy a car. You know what you can afford. You already know what you're going to get. So if you get a $20,000 car loan from Cal Coast Credit Union or another establishment, you know that any car on that lot under $20,000 you can buy today, and it's a done deal. Right? Versus if you want to go sit down with the person, the car salesman at the car dealership and negotiate for 3 hours, and he does 5 different, well, wait a minute, I'm going to go talk to my manager and we'll see what kind of deal I can get for you. And every time he goes back and forth, the deal gets a little bit sweeter. Right? That matters. So what you show over here is kind of the percentage of where most of us in the United States are as far as our credit scores go. Believe it or not, most of us are pretty good. More people have decent to good credit than bad. This fluctuates. So this isn't gospel, but it's a pretty good read. Okay? Yeah. Yeah.
So right now I got a 700 credit.
You have a 700 credit score?
I asked you about, so how much can I borrow the bank?
How much can you borrow if you had a 700 credit score?
Yes.
Okay, so the credit scores and credit report, they're one factor in all the different lending opportunities that they look at. So, I'll explain that in a second. But what they're looking at is not only what your credit score is, that gives them a good idea of what your history has been. That gives you a good idea of what your lending is. Okay, so they won't all of a sudden, just because you have a 700 score, say, I'm going to give you a $500,000 loan for a home. That's one factor that they look at, but they look into many others. They look into, have you owned a home before? What was your mortgage on that? What is your income? What is the total income of the house? What also are your monthly obligations? So not only are they looking at what other debts you owe, but how much other money do you have going out every month? So for utilities, other car payments, students, you might be paying for college for your kids. What's coming out of your budget? They're looking at all of that to assess, right? So that's why you fill out that application. So it's not just credit scores, but believe me, the credit score is weighed upon pretty heavily. Because if you have money, you make good money, but you have a history of bad credit, they're going to think twice about loaning to you, or they're going to loan to you at a much higher interest rate because their risk factor is through the roof. Does that make sense? They're not as comfortable as they would be if you had great credit. Make sense? Okay. Yes?
Can we go back to the previous page?
Yes, sir?
So why the numbers on the second column and on the third column are different? One is 800, 850,
Yep.
but the third one is 750 plus.
Yeah, so what that's showing you is the percentage of where people are sitting. Do you see this column over here?
Yeah, I mean the second column and third column.
This one right here?
Yeah, 800, 850.
850 is the best.
Yeah.
Highest score you can get.
On the right side, you have a 750 plus.
Yeah. So what I'm saying in that, what they're saying is, this 750 to 799 is where 27% of the population is at. Okay? But the tier 1 credit, so like a great example is, you guys hear car commercials a lot, right? And you'll see those car commercials for BMW or Mercedes-Benz, and they'll give those 0% financing. And it's great, and the car is sliding around, and they've got the ground is all wet, and it looks really pretty, and they're driving a car like none of us would ever drive a car. They're sliding all over the place. And they go, and you can have this car. And then all of a sudden, the person that's speaking starts talking really fast. Tier 1, 0% financing is based on tier 1 credit, blah, 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 blah. Okay? That happens because what they're saying is, you better have tier 1 credit to get this 0% financing. If you do not, that is not going to be offered to you. We'll still sell you the car, but it could be 3, 4, 5, 7%. The worse your credit, the higher your interest rate's going to be, which is going to cost you a lot more money to borrow. So borrowing is not created equal.
What is the tier 1?
I'm sorry?
What is the tier 1?
What is tier 1? If you were to buy a home today, tier 1 would be about 750 and above. Now, that's not gospel. Every institution is going to have what they consider in their business what tier 1 is. But that's a very good it's a pretty good estimate. Okay, but 750, I know, I work with lenders all the time. I know right now, anywhere from 740, 750 is you're going to be tier 1 credit. When I bought a home 10 years ago, 11 years ago, 720 was considered great for the lender that lent me my original loan. Now, my lender, which was Synergy One Lending, might be different. I go to Cal Coast, they might say 720 is great, but we like anything above 740. It's just because their assets are different. They might have different business models. Does that make sense? Yes, Kathy.
For a mortgage application, it's federally regulated, they take all 3 scores
Yep.
and average, and they take.
Which is different.
Yeah.
So I haven't even gotten to that part yet.
Okay, yeah.
So the way they're assessing it.
Yeah.
So you've got me, I'm getting to that. Right after this. So that's for a mortgage, but the way that they pull one for a car is they pull one score from one, and if that happens to be the good score, do you guys ever see the commercial where there's a guy sitting in a car dealership and he's sitting there at the table and he's looking across from the lender and there's 3 dudes standing behind him going like this, and 2 of them are really tall and strapping and one of them is really short. And what they're saying is good score, bad score. And what they mean by that is, remember at the beginning I said not all the information might be sent to all 3 bureaus? So with a car, it might be that the way that a certain institution might just pull Experian. That's who they work with. And they have the account with Experian, so they pull Experian credit reports, and whatever that score is, they're going to assess what they're going to give you on an interest rate based on that, how much money you make, what your outgoing money is, and they're going to assess how much they'll lend you and at what interest rate. Because they're assessing what can you afford to take on. Okay? Now, does that always mean that whatever they figure out is something that you can afford? That's a whole different presentation. And you could have come and seen Ray last month, and she would have talked about that in budgeting. How the credit score is evaluated. What do they look at? 35% of the FICO score is created based on your payment history. Okay? If you pay your bills on time, if you pay your loans on time every month, you use that credit and you pay, pretty good chance that you're going to have a decent credit score. 30%, so the next most heavy weighted is what's called amounts owed, or a debt to credit ratio. Meaning, how much have you borrowed, how much do you have sitting on your accounts, versus how much available credit you have to you. So I'll make this simple. Let's say you have 2 credit cards and you have $1,000 available for both of them. So meaning, let's say $500 limit on each of them. Okay? And you have currently $250 sitting on both credit accounts, which means you have a total amount of debt of what? $500, right? You have $1,000 available to you on those credits. So what is your ratio? How much are you using? 50% of your debt, of your available credit. So to that right there, 50% utilization, amount owed, is not a great thing. Just because you are allowed to borrow so much doesn't mean that you should. The whole maxed out thing, that is not a cool thing to be, right? Typically, anything, they're saying, what they say, a healthy ratio is about 30 to 35%. You don't want to have any much more debt than that. Otherwise, your score starts to go down, starts to be affected. All right? Then other things that they look at are like length of credit history. So how long have you had those accounts? If you've had a credit card account with Cal Coast for 15 years, but you don't use it much, and you think, I'm just going to close it, don't. Because that's history that you have built up. Right? You should use it too, because even if it's just once. Because if you stop using it, these banks and these institutions are going to assess where they are. When they loan money, they're going to look at their portfolios and say, what are people doing? We want to assess our risk. And if people aren't using their accounts, and it's dormant, let's say, or inactive, there's a good chance they might say, well, they're not using it, we're going to close it. Okay? Does that make sense? Everybody? Okay. Because an institution can close your account for any reason they want to. There is no law that says they don't have to. If they find that there's some reason, like you have been late quite a bit, or you owe too much money, and you're becoming a pretty big risk, they can say, you know what, we're at this time, due to the credit, whatever reason they might use, they can't close your account. You still owe the money, you just can't use it anymore. All right? Just like you have the right to close your accounts if you want to as well. All right. Does that make sense to everyone? Again, I want to reiterate, credit reports and credit scores were not built for us. They were built to assess risk. So they determine if your loan will be approved or denied, what the lender wants to charge you to borrow. If you have an existing account, should it be, as I just mentioned, should it be closed? And they'll also look at those things to see if you want to be marketed to. All right. Again, this is kind of backwards, or not backwards, it's kind of the same thing, but what are the different things that they're looking at? What are they used for? What goes on your credit report? Mortgage, credit cards, student loans, car payments. These are just some of the things that get sent to your credit report every month when you make a payment. Things like electric bills, cable bills, cell phone bills, rent, they do not get sent. Okay? Even though those are monthly obligations that we pay monthly, just like a loan. Debit cards. How many people use debit cards in here and they have the little Visa or MasterCard on it? Just because you use that and you use the same machine as you do when you use a credit card, that does not build your credit. It is not the same thing. Does anybody know why? It's not prepaid. It's your money. You're not borrowing it. That's right. 100%. As Kathy said, there's different methods that different loans get pulled from. For a home, they will pull all 3 credit scores and they will take the middle one. It's kind of like figure skating. They drop the top judge's score, they drop the bottom score, and they take that one. Right? That's what they do with that kind of lending. A car could be just one pull. Credit cards, same thing. Typically, that's one institution's pulls. All right? They're looking at different things. And I want to just show this to you because this is the last slide that we're going to show you. But what can it do when this is just a very soft assessment, but what can happen and how much your score can plummet based on different things. So this is on your thing. If you go 30 days late on a mortgage, let's say, and your score started at 680, it can drop to 600 to 620 just by being 30 days late. Now listen to this. The better your score is, the more it might drop because there's more room to fall. Does that make sense to everybody? All right, now this is not gospel because there are so many factors that go into your credit score. So if anybody asks me, if I have an 850 or if I have 800, am I going to get a loan for sure? Probably. But there's also you could have an 800 and be unemployed right now and not have an income. That's not going to get you a loan, right? But you might have a lot of debt, but you make it a good amount of money and so you have a high ceiling. That doesn't mean you have a good credit score. That doesn't mean that you're a good credit risk. Does that make sense? It's all very relative. And that's why they take into consideration everything. All right? Are there any other questions that anybody has for me? Yes?
If you apply for a student loan, does that count towards a hard inquiry or no?
I don't believe so.
Okay.
Not when you go through like the Stafford loan. What does happen though is when you do open that account, that does get put on your credit report. And what it'll say is inactive or delayed payment. So if you're in school and you have a loan and you're not paying on it, they're going to know that that amount is there, but it's also going to show that you're not paying on it yet. So yes, it will have an effect. You'll have a footprint now. You take out a loan, it's in your name, it is going to be on your credit report. For sure. Yes?
So I've had a PayPal account for the past couple years now, and recently they decided to extend a line of credit. Can that affect my credit score?
can, if you accept it, sure. What they're basically saying is you've been a good client, and we're going to allow you to, I can't speak for PayPal directly, but typically when they're extending a line of credit, that means that you've been with them for a while, and what they're saying is you can do different types of payment packages or methods via PayPal, or what's the other one that people use all the time? Venmo. Yeah, my wife has the account. I don't know how to use it. Yes?
I have kept over a credit card scores over 800 for 10 years.
All right.
I wonder about, I want to make a more credit card, but my friend said you can make a more, you might lose your point. Just one card I use it. So is it impactful for the...
If you were to get rid of one, is what you're saying?
More, credit card?
Or if you want to get another one, will it impact it? So if you were to, let's just say you wanted to go get another credit card.
Just I use one.
You just will use one, but you want to get another one for some reason. Yeah, so what will happen is typically if you're around 800, you'll get that account. So your score for the first month or so might go down a little bit. It's not going to be heavily weighted. So you have that concerned look on your face. And there's really no reason to be that concerned about it. Because what happens is anytime we do anything, we buy a home, we buy a car, we go out and buy a bunch of furniture, we open up a new account, we borrow, our credit score is going to go down a little bit because we're taking on new credit. But once we start paying on it and it becomes a part of our fabric again, so eventually that second credit card, because you use it and pay it, where now you have two, your credit score is going to actually go above what it was. It's just not going to do it right away. It's going to go down to go up. Okay, but it's not going to go down to 600. It's not going to go down to where now all of a sudden you can't borrow anything. All right, like I mentioned, based on what our activity is, our credit scores are going to do this, depending on when you look at it, when things are reported. Okay? Anything else?
So I have a secured card with Navy Federal.
Yep.
And I pay my balance like off in full every month.
Yep.
But is it better, because I know some people have told me like leave a balance to be paid off, or should I keep paying it in full?
So the argument is, and a lot of institutions will tell you that if you leave a little bit of a balance there, you're showing how to use revolving credit, right? You're showing that you have a balance, that you know how to pay back with a balance. But I will tell you, the difference is so minute that financially, to pay an interest rate on something you don't have to pay on is ridiculous. Use it, pay it off. It's fiscally responsible, right? It's smarter for you financially. Is it worth a point here and there, a couple points? I mean, not really, because remember, we go in tiers. It's not going to be a major effect. Never, ever go into debt because you think you want to build credit. Okay, and because people do that, they'll go out and, well, I have the cash to buy a car, but I'm going to take out a loan so I can really build my credit better. I don't really understand that thinking because it's not financially viable, but okay, realistically, credit cards are going to build your credit faster than anything. Why? Because they have a ceiling. They tell you exactly what your amount is you have available to you. Not only that, you can dictate whether you spend a lot or a little, right? So you can, let's just say this, best way to build your credit, how many of you have a cell phone bill that you pay for every month directly to the cell phone company? Okay, so if you used your credit card, right, you could have that automatic payment, it gets there on time, and then when your cell phone bill comes in, pay it like you paid your cell phone. You're killing two birds with one stone. One, you're not adding to your debt. Two, you're using your credit card like you are in your budget. You're paying for your cell phone, but now you're establishing credit. That's all you need to really start to build your credit, especially for younger students.
Reward cards.
Yep.
I've seen stories on the news where people are playing the game of opening new accounts to get these introductory reward deals. And then you see them with a binder of like 20 and 30 cards because they've only been chasing the rewards.
Yeah.
And using one card to pay off another just to get the rewards.
Yeah.
Does that affect your score?
So one other thing, by law, you can't pay other credit cards with credit cards anymore, or I don't think institutions allow it. And Kathy, you can respond to that better. I don't think, I had friends in college that used to pay one credit card to another credit card. We called it credit card roulette. I don't believe that that's allowed anymore. I don't believe institutions allow you to pay, unless it's a transfer, which is different. Balance transfers, but making an actual payment with a different credit card, I don't believe you can do anymore. call that, it's kind of piggybacking, but as far as the rewards and talking about that, that can be very dangerous. If you are a super highway and I want all these rewards thing, you still have to treat your credit cards within your, like they're in your budget. They still have to be treated like they're cash. Because if you don't have credit card payments and you're using them for other things that is not in your budget, almost guaranteed you're going to accumulate credit card debt. And that is extraordinarily dangerous. And I speak from experience. $27,000 in credit card debt by the time I was 26. First credit card my freshman year of high school or college. Graduated with 5 of them. The economy was really good in the early 90s. And they just kept saying, Mr. Peckham, please borrow. We're going to increase your limit. Every time I came close to a limit, they'd increase it by $2 or $3 grand. It was crazy. I was like, oh, this is the best thing ever. It ended up being terrible because it took me 8 years to pay it off. And believe me, nobody wanted to date a guy that had that kind of credit card debt and couldn't go do anything. Trust me. Good questions.
Yeah, my sister has credit card. She said bad score, so she cannot buy the new house. She wanted, then nobody borrowed the money from bank. Can you?
She has a good credit score, but she can't get a loan?
So bad score.
She has a bad score.
How to make it
Better.
Yeah, better.
That's what I was, so look at the way, it can take a while. Once you have bad, the one thing about credit scores and credit reports, the older information gets, the less it's weighted. So if you have something that, where, let's say she missed some payments on some stuff, and that's relatively new, that's going to be more heavily weighted than if that happened 5, 6 years ago. Within a year, it starts to go down. But there's no exact date on it. There's no way for me to just say, after 6 months, it's not going to be as heavily weighted. It just doesn't work that way. The longer it gets, the older it gets, the less weight it's going to carry. Okay, so your score will start to go up. But the only way to really build your credit is keep your debts low, keep your balances lower, and to make payments on time. Okay? That's the best way to do it. And it's really the only way. Outside of trying to get a quick fix and trying to go to an organization that can fix credit, that's a whole different story. Thank you, everybody. Enjoy your burritos.